Hello and a warm welcome to the JSE Investor Avenue Conversations. I'm your host, Gugulethu Mfupi, where over the next few series of conversations, we'll be giving you some insight as retail investors to fully comprehend how the JSE as a key institution, the largest capital markets player on the African continent and a key leader in this space, is making themes and conversations around investing more accessible. We'll be talking about a wide variety of topics and themes, all up our alley for us to understand, and really giving you a refresher in terms of the understanding you need to have before embarking on your journey of investing. Before, or perhaps just reinforcement for those of you who have already started your investment journey. Today we're going to be talking about Investing 101. Getting the details of fully comprehending what this means, especially when it comes to share ownership and having shares in listed entities. Today we have our guest, Bright Khumalo, who joins us from Vestact. He'll be giving us an understanding into everything we need to understand about shares. Bright, such a pleasure to have you with us for today.
Gugu, lovely to be in your show.
I'm excited for this one, right?
Awesome.
Because it almost takes us back to just the basics of understanding, and regardless of where someone might be on their journey, as a beginner, intermediate, or even well experienced in terms of investing, it's always a good idea just to get a refresher in terms of perspective of everything to do with investing.
Yes, and as you know, fundamentals are where my passion lies and the reason why I started this whole career. So
definitely.
I'm happy to be the one doing it.
Let's not forget they do call you the dividend puppy, but that comes from a theme that speaks to dividend payouts when it's related to shares.
Correct.
But to have shares, you need to be invested in a company. So perhaps let's take a few steps back.
Yeah.
Just to fully comprehend the correlation between investing and shares. Essentially, what are they?
Yeah, so basically investing is obviously when you've raised enough capital and you want that capital to work for you. So raising capital just means, you have cash that you've been saving towards a goal. And the goal this time is actually to put it in an asset or in a thing that's going to generate returns for you, or it's going to make more money or money babies for you. Yeah, for that capital. So that's what essentially investing is. It doesn't necessarily means putting money into shares. Mm-hmm. You could put your money into a stock fail. You can put your money into a 32-day notice account. You could put your money into buying a car, but that's a depreciating asset unless that car generates profits in one way or the other, revenues in one way or the other. For example, you put it on Uber. So that's also an investment. But our focus, like you said, is going to be around shares, which is what we like here. And I'm happy to actually be doing it here on the JSE because, it's 360, right? It's awesome. So shares in particular, what they are is basically buying, a part stake or ownership into a larger institution, a larger business. Mm-hmm. So I'll let you ask the questions, more on shares.
But I'm loving the role that you actually have because as you're saying, you're buying a piece or a stake within a company, right? And for many of us, when we think of it, you think of a picture or a circle or a pie,
yes.
And actually understanding that each and every one of us can actually have a slice of the pie in terms of gaining access. And maybe that's a good point just for us to actually get a refresher in terms of, how these shares might be defined, how it comes about, because this actually speaks to an actual structure.
Yes, it's very a good example I can make is, when you had, the equivalent of Civis Day at school,
yes.
And you were allocated a stall. Some will be selling sweets, some amaguinya, some they'll be selling lemonade.
Yeah.
So essentially your parents invested in your business, for you to be able to buy the stock, the ingredients you need for your lemonade stand or for amaguinya or for whatever you are selling, right? So by doing that, you are the entrepreneur. You need capital. You go to your parents. They give you the money. You buy the ingredients. That's the process of operations. And they put them together. And then comes Civis Day, sales day. That's what you do to earn the revenues. And obviously, everyone knows that, at Civis Day, you wanted to make the most money. You wanted
exactly.
to maximize the money. So by maximizing the money, you're gonna, basically what you're trying to do is make more revenues than what your parents gave you.
Exactly.
And if it's higher than what your parents gave you, you had a profit. And you can give them their money back and you have some money left over, to go buy a nice pair of sneakers. So that's essentially what investing is. But instead of, going through the whole process of putting the ingredients together yourself, you invest in a company that already does that. Yes.
I'm glad that you're explaining this, because for a lot of us, that then helps us conceptualize and understand how this forms the fundamentals of themes that often get discussed a lot later in terms of dividends, the different kinds of dividend payouts.
Yeah.
And even that, again, relates to the different kinds of share ownership, right?
And
perhaps,
businesses, yeah.
Exactly, and businesses. And maybe talk through that, because typically we think, well, I'm investing in a business is a business, a structure is a structure. Are there different types?
There's very different kinds of ownership. For example, entrepreneurs are willing to give you equity in their business. So that's what listed shares are in essence.
And equities ownership, right?
Yeah. So when someone says, you give us money and we give you equity in a business, it means they're giving you, a pro rata stake in the business or shares in the business for the amount they are taking from you as the funder.
Exactly.
Yes. Other different types of ownership, some people are not comfortable with taking the risk of, the ups and downs of the business. So they want to loan the company money, so they guarantee that the capital they give to the company comes back to them. So that'll be, things like loans, like I said, maybe preferred shares. These shares have, they attract interest only. So if the business does exceptionally well, you only get back what you gave them and a bit of interest that was pre-arranged and pre-agreed upon. So anything above that goes to, the guys that took all the risk, which are ordinary or common share owners. The guys that say, I'm giving you the money, do whatever you want to do with it. And, once you've paid all the salaries, your loans, etc., then you can pay us a dividend. And obviously those guys also get a benefit of the share appreciation. So let's say the shares were issued at 100 rands and the business operations double. The shares are now worth 200, okay? And they could still get a dividend sometime in the future. So, there's a bonus there. But also, if the business does not do well and it falters and they go into bankruptcy, you get absolutely nothing. Whereas, people who had borrowed the company money, they are first in that, pyramid of getting money back. And then shareholders are right at the bottom. Once they've wound down the business, they've paid everyone salaries, loans, deferred shares, whatever.
Yep.
Whatever is left behind then is going to be split equally to the shareholders, obviously based on how much they own, not equally, sorry.
Definitely.
Yeah.
And this is important, especially for us as retail investors, right? Because you've got money that you've worked so hard for. You are willing to take on perhaps a certain amount of risk. And that in itself also depends on you as an individual.
Correct.
And the kind of appetite that you have. And maybe that's a good point for us to also reflect on, just in terms of identifying what kind of shares you'd like to own in a business. But also, maybe if you can contextualize this with the history of shares and how these themes and different aspects also happen to come about.
So there's two questions there. We'll probably dial back on the history, but let's talk about then the first one. See, now I'm forgetting
Your preference, essentially, as to what kind of shares you'd like to own in a business.
Yeah, so basically there are different, in the risk spectrum of shares, there are different kind of shares. Obviously, if you invest in a smaller business, you're taking a higher risk. Because, there's a lot of competition. They're much smaller. Maybe they can't get the kind of loans they want to get on the banks. So they come to individuals. They're still building up. Startups in general usually have a higher risk, as compared to, blue chip, the companies that have been listed for years, that have had profits, they've got a profit history,
Yep.
and they have a history of growth as well. So that usually is lower risk. It doesn't mean it's no risk. Yes. So what I do, for example, for a living, is I invest in listed shares that are, the top 40 largest companies. I can't, my mandate doesn't allow me to go outside of, the big companies. And when we go offshore, my mandate doesn't allow me to invest, in the companies that are smaller than the top 1,000 biggest companies in the world. So,
and this is important, Brian.
Yes,
because what you're also telling us
stuff.
is that you stick to the big stuff, which is also similar to what a lot of institutional investors do. So
Correct.
When you and I contribute to our retirement or pension fund, essentially this is money where there's a lot of liquidity.
Correct.
It's big companies that you say
Correct.
have a good reputation and understanding, clear governance and controls, which effectively is managed by the capital markets or institutions that they might be listed on.
Like the JSE, if you list on the JSE, obviously there are structures that you need to follow, right?
Yeah.
So that does give you some sort of comfort. But I focus more on the big stuff because that's the amount of risk my clients can tolerate. So that's determined by the mandate there. But when it comes to, the history now of stock market, that's for us South African, that's a very interesting story. You'll understand why, because basically the concept of buying shares or a company listing on the stock exchange and then coming to the general public and saying, we're going to be raising funds, we're listing a portion of our business in the stock market, that ever first happened in Amsterdam in the 1600s.
Whoa.
So 1608 to be in particular, and the company in question is a company that lived a very long life called the Dutch East India Company. Very controversial, considering our history and apartheid here in South Africa, because the Dutch East India Company, for those who don't know, they were basically a business, with lots of ships, and these guys would go out and create value for their king or queen at the time. And by creating value then, get slavery, the slave trade, all of those bad things that we can't really talk about much on this podcast, but you get what I mean. So it started there, and I think in the 1700s, we had the the New York Stock Exchange, and then obviously more and more stock exchanges started to come about because trade in the US was very big. That used to be a very popular spice route. And now it's no longer a spice route, it's more financial services and technology route. For context, how we've developed over time. And back then, by the way, technology wasn't necessarily what you think of when we say technology. Today, when I say technology, you think of computers, you think of, the internet, you think of ways, software companies and all that stuff.
Yeah.
No. Technology back then meant something mechanical, If people used to drag their load to put it in ships, putting 2 wheels on it, that's technology, that's advanced, that's, progressing faster. You can now push more loads to the ship.
Sheesh.
Yeah, so we've come far as humanity, but this is why I love investing, because you're always somehow in the forefront of those businesses that drive change.
Exactly.
Yeah, and you never really see that outside of where you are forced to see it. Like, when they started forcing us to use computers at school, you wouldn't have seen progress if you don't invest, except the ones that you're forced into. Hence why people who actually see these trends come up very quickly, and these trends stick. Think of the chip makers, companies like Nvidia, Intel, AMD. Those companies, they've been around for a really long time, but people are only hearing those names now in 2024. But they've been in the forefront of, processing power in the world.
Definitely.
In everything we do.
Exactly. Yeah. And what you're actually describing here is a beautiful evolution, right? And which
Correct.
we're grateful has taken place to actually be more relevant within the times that we live in. But it has also contributed greatly to the advancement of society, economies, and of course businesses, and even investment structures, as we know.
Yeah, but people usually ask me then, so why would someone want to invest?
Yes.
So what's the point of that? What do you think?
I think we all want to build wealth, right? Because the truth is money gives you options, and wealth perhaps from an individual point of view does contribute to the options that you can certainly have in terms of the betterment or the better quality of life. But that's a very selfish reason. But investment does help propel economies and the advancement of businesses, right?
Well, I was going to put that first, but wealth creation is definitely somewhere at the top, especially on the individual standpoint. Wealth creation, like you said, runs economies and all of that. I agree with everything you said, but I don't think I can really add much to that. Businesses do a lot. They hire individuals. We use those salaries to raise our kids. We send them to school, and it becomes, this circular thing where money goes in here, it goes out somewhere, and that money creates value for someone, and eventually it becomes bigger and bigger and bigger.
Right.
Whether it's, it starts from a small community, that community becomes, ends up becoming a bigger community. I mean, you've seen things like very small communities that you've never heard of before, and all of a sudden you know of them because of a certain thing that they produce. You can think of small Italian, villages that, create Dior bags, that create, like the dream of Salomeo. Salomeo, for example, they create nice mink jackets, that just came from one entrepreneur and said, you know what, I want to do this thing, but I want to do it in my community.
Yeah.
And they've created billions and billions of euros of wealth.
Exactly.
So if you were in that community, you invested in the business, you had shares, you're now basically retired. There's obviously technology in Silicon Valley, in Taiwan, in Shenzhen, in Hong Kong.
Yes.
There's quite a lot of that happening. I mean, these communities are very different from each other, but they all have the common goal of creating value.
Exactly.
Yeah.
I appreciate how you've taken us through this full value chain of understanding not only the history of shares as well as investing, how it positively contributes to society and the advancement of really human capital overall.
Yeah.
And of course, how this does speak to the one reason that we're here for, to discuss investing, and it's important in having shares. So it's beautiful to see the ripple effect that having the confidence, taking on the risk, having the capital to allocate into a business and invest through share ownership, then does translate to this level of growth. So someone might be sitting here and thinking, well, these old communities, these old states that we've just been referring to, one would sit and wonder, well, how are these shares actually issued? And back then it was very different, but in the current day and age, this is essentially easily accessible through JSE listed stocks and perhaps even others across many other stock exchanges.
Yeah, so correct. So you and I, Google and Bright Inc., we've just started a company. We offer a certain service or we manufacture a gadget, but you and I's monies are finite. So we go to our family and friends, we raise a bit of capital, our business gets bigger, we hire 10 people, and then after that, these people, the community, the society likes our, gadgets so much that, the demand is higher than what we can supply currently. So we need to invest in a second factory or a third factory, hire more, talent, etc. So eventually it becomes very tough for us to get funding. So we go to the banks, we say, hey, look, we'd like to give up 50% of our business to new shareholders. Can you guys help us structure a deal where anyone in the public can subscribe to these shares at 10 Rand a share? So then our company gets a valuation. They go around, on a roadshow, basically helping us market our gadget.
Yes.
It so happens that everyone is already aware of our gadget.
Yes.
And they like it and they want to invest in the gadget. So they do tell their friends to put down money. They also put down money. We are able to raise however X amount we needed to raise. We come to the JSE, they float our shares, and all of a sudden, every individual who was associated with this gadget, from knowing it, is now owning a stake in our business that produces this gadget. So, and obviously they share in the spoils, the ups and downs of, being this gadget producer.
Definitely.
Yeah.
And let's talk about those ups and downs, because in my day-to-day life, that's typically what we report on. The markets have gone up, the markets have gone down. This company reported financial results. This is what the numbers look like. And this actually
that's the fun part.
Yes, that's the fun, and the part that you enjoy as well, which actually determines which company you buy more shares in or less shares in, and influences your investment strategy. And I think that's a beautiful way for us as well to encapsulate that shares, yes, at the time when you buy them might have a certain value. We're hopeful for capital appreciation. We're also hopeful for dividend payouts. But help us understand and contextualize that ride, market sentiment, what determines the value or the price of a share at any given time, especially in the listed space.
Yeah, so this is very hard because there's many different ways of explaining it. What's the value of a business tomorrow? Because essentially, when you take your money today and say, look, I have 100,000 rands and I want to invest, or most importantly, I'm 25 and I want to invest for the long term and I have 100,000 rands, how do I go about it? It gets very interesting because there's many different investment philosophies. Some people will say you should be looking at buying companies that are trading below their net asset value.
And that's where things get technical, right, Brad? Because when you're sitting at home and you just want to trust someone with your money, That's not the kind of maths and complications you want to talk through.
Correct, but let's now remove, those nuances.
Got you.
That jargon around, what to invest in and, the free cash flow, future value, what. Let's just basically put it in simple terms. So essentially when you have money today and you probably don't need the cash today, so you want to invest it in the stock market, you should be looking at having a time horizon of, call it 5 years and more. Because these, like you said, these assets move daily and the moves could be brutal. We've seen companies go down. Companies as big as Nike, for example, most recently have gone down less than 20% and then come back, 15%. Maybe some people will be in the green soon, the people that invested recently. So yes, it's very volatile. So that's why the time horizon matters. Now we come back to the investment philosophy. Essentially, I'm going to talk about what I do and how I invest, because it's much easier for me to sleep at night knowing I invest in that. So I basically invest in technology, health and wellness, and pharmaceuticals and biotech, biomedical sciences businesses. These are all businesses.
You're not a deep value guy.
No,
looking at commodity based.
Not just that. I don't do commodities. I don't do deep value. I don't do cyclical stuff. Think of mining. Think of construction. Think of anything. Even think of the fast-moving consumer goods companies. Yes. So think of stuff like that produces a commodity-like product. That when you buy bread, it's not different when you buy from Blue Ribbon, Albany, or BB, or whatever brand you buy bread from. So
exactly.
I don't want that. I like differentiated companies. It's great if they're trying to solve a big problem in the world.
Got you.
So think of, Elon Musk and trying to make sure that everyone is driving EVs. I know that's probably a bad example, but it's good enough. Think of Google. They were trying to solve a problem of centralizing a database where it has all the information you need to do any kind of research. So you go on a search query, you type in your problem, and 2 seconds later, voila, God has answered your question. That's exactly the stuff I like to invest in. But this stuff comes at high risk because it's a high growth environment. So this is when diversification is very important. Meaning, instead of just buying Google alone, you have to have a well thought out portfolio of these shares in different names. So Google, Amazon, Naspers, Discovery.
Got you.
Go down the line. That way, if one does well, at least if one does badly, at least many others are doing not so bad. That's essentially what I do and how I look at investing. And investing in something that has, I'm going to think of tobacco companies.
Yes.
They're not really solving a problem that I'm interested in. They're not really doing anything positive to society. They could be paying great dividends, but that's probably going backwards as well because their market that they serve is getting smaller and smaller. The more people are aware of fitness, their health, their wellness. So hence why that's my theme. I like health and wellness. So bring me those on shoes. I'll buy those sneakers.
The technology, the innovation.
Exactly.
Love what you're describing, right? Yeah. And even the reference you made to what would typically just be described as sin stocks. And this world of changing, governance and climate change and even health and awareness, it becomes a lot more heightened in terms of how we need to determine our investment strategies. And this is important, right? Because for anyone who's sitting at home watching this, as we're describing, we're talking investing, we're talking shares, we've understood what kind of shares and businesses we can actually invest in, but we don't really perhaps have a great appreciation for that investment strategy. I know you don't offer financial advice, but this is where perhaps we can offer guidance as to what to look for in terms of determining an appropriate investment strategy for you when it comes to the shares or investments that you'd like to make. And this typically means speaking to someone who is professional and can guide you, right? Because everybody's needs are very unique.
Correct. Like I said, the one I mentioned earlier is your age is really important.
Time in the market.
Time in the market is the most important thing. They always say time in the market, don't time the market.
Yeah.
So your age, I can't say Gugu's mother comes to me, she's 60 something years old. She comes with, 2 million rand and says, right, here's capital, do what you need to do. I'll go back and hope for the best. And then I say to her, yeah, it's fine. We'll put you in these high growth, high risk stocks. That's probably not her situation, depending obviously,
yes,
or, her lifestyle. If Gugu's mother is a billionaire, that probably doesn't matter. We could put her in anything. But if these are her hard-earned savings that she might need in 5, 6 to 10 years from now when she retires,
the priority is to preserve the capital.
So that will be first my priority, and I'll probably allocate 65% of the portfolio into interest-bearing type assets. So I'll be looking at REITs. I'll be looking at
REITs, real estate, list.
These are property shares that pay out basically 100% of their profits to their holders.
Yes.
So the dividends you get from them are treated actually as income. So think of it as a salary rather than a dividend. So they are taxed higher because the people that receive that money usually are much lower on the tax brackets because they don't have other income. So you look at stuff like that, and maybe they want to buy not common shares, but other sorts of shares that pay high yields, like preference shares. High yield just means a higher interest rates than where inflation is probably sitting today.
Gotcha.
Maybe they want to add bonds for diversification. So I would put, say, 65% of that in her portfolio.
Gotcha.
And then the remainder, I can say half local shares, half offshore shares. At least she still has that growth component in her portfolio.
I hope you heard that, Ma.
So it depends. It depends on a case-by-case basis. But how you find your investment philosophy has a lot to do with more of the psychological side of you as an individual. Some people, they are more inclined to listen to stories and, they invest in stories. That could be, something people invest in.
That sounds rather emotive, yeah.
Exactly. Some people like to look at their numbers. They like to have a quantitative-based approach into investing. So they will look at things like, their revenue as a ratio to its profits, sales ratios, all of these other things. And then they create sort of an investment philosophy based on that. Some people will say, okay, I like to buy cheap stuff. The cigar butts type of investing. There's a cigar that has one puff left. You pick it up, you smoke it, you throw it away. But the throwing away part is the hard part because you don't know when, how much of this cigar you could take a puff on. But yes, exactly. So there's that approach. There's the growth approach that I described, that I like, that I favor. There's many. Some people, think of not Warren Buffett.
Charlie Munger?
Peter, I forget his name. Not Charlie Munger, but essentially, for example, we're sitting here, you have an iPad in your hand. You're using an iPad, maybe you should look into investing in Apple because it's a product, you understand how it works, you use it every day, so you should be invested in it. You're wearing red bottoms, you should be investing in LVMH. I'm wearing Nikes, I should be investing in Nikes. Exactly. When you eat, where do you buy your food?
Because it's relatable and tangible, right?
Exactly. I buy it at Checkers. But also he said you would be the first person to notice if there's ever a difference that's happening. For example, you walk into company A retailer in white, and company B, a retailer in green. Every time you go into retailer in green, things are going up. They've just hired bigger space to put in a daily inside the retailer. You come in, prices are always competitive, things are always fresh. Here, the white retailer, they're doing okay, but there's no change and nothing much is actually going on there. You probably should be investing in retailer green. Exactly. So that's sort of the thinking of that investment approach, and that's what most people are inclined to do. But sometimes they don't see the blatant signs in front of them when things start to change for the worst, or when things start to change for the better. Because when you have a portfolio and you're investing monthly, you're saving monthly to invest monthly, when things are going well, things are changing for a certain business and they're changing for the good, you're supposed to be able to see that and allocate more to that company than you would the companies that are sort of stagnating or are doing okay.
Exactly.
Yeah.
I'm glad you've taken a very full view of investing as well as the share ownership, which is really critical in terms of understanding the full journey that we embark on, right? And the basics and fundamentals have been set for us. But one thing that we are also excited to discuss, right, is of course looking at the benefits. And one thing you've mentioned is reallocation. Especially when it comes to shares or companies rather that are doing incredibly well in terms of their performance. And that helps us understand the benefits. We've touched on the risks as well of being a shareholder, but also how to actually embark on that journey. And maybe this does speak to just the process of managing your expectations as a shareholder, understanding your level of influence on the business and its strategy through shareholder activism, attending AGMs, and key aspects of the business to constantly keep in mind. So you don't just put your money in something, close your eyes and, wish that it does well.
That's a strategy. Hoping is a strategy, but I'm not sure it works.
Yeah, I agree. There might be others who might vouch for it and others like us that might not. But again,
I'm very skeptical.
Exactly. Depends on your strategy. This level of awareness, as you say, outside of just looking at how the retailers are performing, the brands that you invested in are performing and what they're doing. What else do we need to be cognizant of that actually speaks to your role and actually responsibility of being a shareholder?
A shareholder. So I think everyone would agree with me when I said you should at least be reading all the financial statements that they release. There's usually, even though management is usually very bullish on the future, just look at what they're saying and just listen to what your friends are saying about the brand as well and try to compare the two if they make sense, because that's how sentiment now is formed.
True.
And
that same sentiment actually influences the
share price. So what people are saying about the company and what they're seeing obviously on the ground by, because consumers vote with their pockets, their wallets, and management is always trying to paint a picture that, we're trying to do good or we are doing very good. So you need to be, very, very rational. Read the financial statements. When they say it's good, are they really growing by 20%? Because if you're saying you're really good on a relative basis because everyone is down in your industry, I'm like...
It's like choosing that pair of socks that's the least dirty, essentially.
Exactly. Whereas if maybe the whole industry is the one that's not doing well, the question is, maybe should I not be removing my capital from that industry and allocate to another industry that's on an up and up?
Gotcha.
Because selling, they always ask you about a selling strategy. It's the hardest thing that an investor has to make. It's the hardest decision that any investor has to make. It's not easy knowing what to sell and when to sell.
But that also speaks to what your investment goals and objectives were, right?
Correct. And how long you've given the company you're investing in a chance. Because, for example, a lot of people will say, I'm a long-term investor, but at the very first sign of adversity, the share price is down 17%, maybe they're down close to 20%, they say, I don't think investing is for me. Because they were expecting that as soon as they put money down, the shares are going to be up. Now that they're down, they're like, this feels like a scam. But also, you could be in my shoes, because I was, when I started my investment journey, I was, on a journey of total failure, because I came into the market in 2010. The 2008, 2009 financial crisis, everything went down. So if you were starting to invest in 2010, basically everything was going up. So you start to think, maybe I'm good at this thing. Maybe I'm a little bit of a genius. Maybe I can make a lot of money doing it. So then you start getting, big-chested, big-headed.
And quite aggressive in your strategy.
Exactly, and quite aggressive. And I did learn some expensive lessons that, were school fees. We're supposed to, I invested in things like Ellie's, for example. Back in the days where Ellie's actually hit 9 Rand, not this Ellie's now. I invested in IPSA. I don't know if you still remember IPSA.
Remind us of IPSA.
So IPSA was supposed to be an alternative energy company to Eskom. So they got a tender to build, I think it was a power station in the Free State, if I'm not incorrect. So the share price went to 10 rands, and we all got excited, and we bought. I think it still trades, or maybe it got delisted. I don't know. It's only now we are talking about alternative energy to support ESCOM, which is a little bit too late, because had we actually, as a country now, focused on allocating some of this, the energy spectrum to these companies, we wouldn't be finding ourselves where we are today. But I digress. I'm trying to talk up my Ipsos stock here that I had back then. But so I did have a lot of companies that actually went to zero. But at the same time, the companies that did exceptionally well did so well that it didn't matter. For example, I heard someone saying there was this company called Naspers that I invested in. I can't remember. It was Naspers, it was SAB, and something else. They were all trading around 400 Rand, 500 Rand
at
back.
the time.
Correct.
Whoa. If you know anything about where the stock markets were performing back then and where those share prices are today.
So there was transaction capital which did exceptionally well.
Yeah.
Even with the current, where they are
structure.
today. Yes. I mean, there was a lot of money to be made at Dapt IT at 33 cents. It's crazy. So, so I definitely was on a path of total failure because everything we touched, went up a lot.
Right, this is refreshing. And I want us to emphasize this, right? Because coming back to our theme and concept around investing and the importance thereof, it helps us also understand and appreciate that this journey is not set in stone in terms of constantly being in an upward trajectory.
Correct.
You invest, you own shares in a business, you understand, yes.
Some might go up.
Yes.
Some might go down.
Exactly.
But on balance, you want to slowly be gradually in the green.
Exactly.
A simple example would be Warren Buffett, who's invested since he was 11 or whatever the story is, or 8. He only made his first billion after the age of 50. But after that, the J curve just worked towards his favor. And it wasn't there were new companies here and there. Coke, it was still old Coke giving him dividends to invest further into other things. It was still American Express doing the exact same thing. Eventually, those businesses became so big that the cash flows that he took in dividend per quarter were more than the amount he invested back in the 1980s into those companies.
Gotcha.
So eventually that's what we hope happens one day, that our dividends are bigger than our capital we put down. This means being always invested in the markets and not trying to time the market and coming out, selling everything, paying lots of taxes, and then going back again and then redoing that whole thing as soon as markets are down again because of another small kink in the market. Because in the long term, markets tend to do well as long as you're in good companies. You buy shares in these good companies and just hold through the course, and obviously try to avoid the ones that bomb out 100%.
Exactly.
You should be fine in the long term.
Exactly. You've given us a full 360 view here, and this is so important because, as we know, shares do and share prices do face a lot of volatility in terms of the macroeconomic environment, the operating performance of the business itself, the sector that it's in, as you've said. But one thing that remains important is your responsibility as an investor to understand what your investment strategy is, what kind of growth you're looking for. We're all constantly chasing alpha, but of course, when to actually restructure your portfolio when necessary. What's important here as well, Bright, that you've touched on, you commented on REITs earlier. Of course, there are losses that you might experience in terms of capital depreciation or losses, and maybe even a recovery after a long time. But perhaps when you wake up one day and you say, you know what, I'm content. I'm actually going to divest from the market, or as a shareholder, just going to take a step back in terms of this particular activity. Not typical normal behavior, I guess, for investors, because once you're in, it's typically a journey that you embark on, just on a constant evolution. But what are the responsibilities we need to be mindful of should we divest? Taxes,
Correct.
The process, the fees?
Yes. So that's a very case-by-case question you're bringing. So obviously shares, when you invest in shares, you hope for capital appreciation. And when you do get that capital appreciation, maybe you're selling for many different reasons, right? You could sell because you want to get married, you want to buy a ring, or whatever the story is, or you're selling because you've come of age where you need to allocate more to other more stable assets. That's also a very good reason. You're selling because you want to buy a car. You're selling because of 1, 2, 3. That portion between the cash you invested and the gains that you've made or the profits, those are taxable. After the first 40,000 rands in gains per year or per tax year, those gains are taxable. And you need to be very proficient in tax laws to understand how to do that. But as I understand, it's not that hard to calculate. And your service provider does give you a certificate showing how much how much gains you made in your sale and how much taxes you owe to SARS. And SARS would automatically know that when you file your taxes. Just always remember that there will always be that portion that you need to pay if you sold something that had giant gains. This obviously it's not only for shares, but any asset that did appreciate in capital, because it could be a car that you bought knowing it's going to be a depreciating asset, but then it so happened that you had an M3 CS collector's version that became really popular sometime in the future. Even though it has 200Ks on the clock, it's still a collector's item, and you're trying to sell it, and it's now 2 million more than what you bought. You have to pay taxes on the $2 million.
Exactly.
Yeah.
I'm glad that you've emphasized that, because these are themes that we do need to be mindful of in terms of not only getting in and starting to invest, but also some of the consequences that you'd also have to face in terms of stepping out.
It's nice making money, but it's very hard for people to actually pay their dues, pay your taxes, guys. It's part of investing. It's part of life. I think it was one of the hedge fund managers, Bill Ackman, I think he said, for half of the year I work for the government, for half of the year I work for myself. And
even that, as you say, is a form of investment that the government tries to drive into communities in terms of ensuring that we unlock a lot of opportunities there. Bright, we've gone on a beautiful journey talking about the history of shares, the understanding of the variety of shares that exist, our roles and responsibilities as shareholders, why and what it is that we need to be mindful of in terms of our investor behavior and investment strategy that then influences the kind of purchases or investments we choose to make in stocks and companies, and even understanding the volatility that drives and comes out from there. We also know that there's several platforms, companies and individuals like yourself who take it upon themselves to walk this journey with us, so that as retail investors, we're not bombarded with this particular amount of pressure. But to close off with, for someone who might be sitting here having gained a wealth of knowledge in terms of the history and understanding you've shared with us, and even for the novice who's still yet to embark on their journey, the one closing comment that you'd like to leave us with in terms of understanding our roles, responsibilities, and the importance of investing, and of course how to be a proud shareholder, hoping that one day we can also call ourselves dividend puppies like yourself.
No, the best time to have invested was yesterday. The second best time is today. So if you are in a position where you're saving, you've got cash left over after, all the costs and expenses of living in South Africa, you've paid for all of those things, and you still have, disposable income to spend, it's probably best you save it in the stock market in one way or the other. Buy shares. Don't look at them every day. They say don't peek, PEEK, and enjoy the journey and try to equip yourself as much as you can by consuming good information on these shares, by going directly into their websites, downloading their financial statements, reading, stay curious, think beyond what you're being told about these businesses. Try to find specific insights. It's even better if you are invested in a sector you sort of have an insight in, that you are superior in understanding than others, because you will see the cracks before everyone else, if there were cracks in what you invested in.
100%.
So, get invested, stay invested, and be happy and enjoy the dividends.
Definitely.
Yeah, the word is dream. Dividends rule everything around me.
Dividends rule everything around me.
Yes.
We like that one. We're sticking to that one. We're going to run with it. Such a pleasure speaking to you, Bright. I'm looking forward to not only the feedback we'll get from this conversation, but of course, future conversations we'll have that certainly interlink to the themes we've discussed today. So thank you again for your time.
No, thank you, Gugu. This was lovely.
Fantastic. Well, that is Bright Khumalo of Vestact. And as you've witnessed, we've walked through a phenomenal journey of really understanding the intricacies, the scope, the breadth, and the depth of Investing 101. And of course, the importance that shareholding or share ownership does play in this regard. Many themes, many concepts, and some that we'll have the opportunity to deep dive into in the follow-up conversations we'll have here on Investor Avenue. Don't forget to share your feedback, give us some of your ideas, and of course, even further questions that you might have, and we'll be happy to address them. But for now, that's where we'll leave it for today.